This is the current federal tax developments for the week of March the 3rd, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and we're going to listen to this week, or kind of talk about this week's developments in the area of federal taxes. Looking at first a FinCEN announcement on a new delay, or at least somewhat of a delay. We're going to see what we know about it based on the beneficial ownership information reporting deadlines. As we've been aware, this has been going all over the place. We'll talk about where we stand currently now based on this week's issue. We also have a tax court case of Alan Hamel and the estate of Suzanne Hamel, who you probably better knew as Suzanne Summers, basically the actress, versus Commissioner. This involves a tax shelter issue. So we'll talk a lot what was going on there, and a decision related to the partnership audit rules under TEFRA after kind of reevaluating them following Loper Bright. We also have the IRS this week released the Dirty Dozen tax scams for 2025. We'll talk about what those are, what the IRS is warning people about, and what we'll be looking at. We also have a couple of new tax documents added to online accounts. So individuals will be able to get information on their W-2 and on their 1095-A directly from the IRS website if you have an IRS account. We'll also talk about a couple of legislative happenings this week. First, the Ways and Means Committee passed out of committee 2 disaster relief bills that passed by unanimous votes. So good news there. From that standpoint, we'll have to see when or if they get action in the House and when or if they get action in the Senate. But at least they have a promising start. And finally, we had both the House and Senate pass budget resolutions. But they're not anywhere near the same. But it will get underway, or at least allow them to start a conference, to come up with a unified budget resolution, in theory, that would allow them to start the process for doing the reconciliation process that would allow them to pass a tax bill. Most likely the Tax Cuts and Jobs Act extension, although that's up in the air a bit because the Senate doesn't know that this is the reconciliation bill to use for that, but would allow them to pass that without having to worry about clearing the rules in the Senate for having to get a cloture vote passed with 60 votes. So we'll talk about where we stand on that, what the next moves are, but we are headed to conference, but we're not headed to conference with 2 resolutions that are really close to each other. So again, it may be a more interesting conference to see what they come out with. And then, more importantly, can that resolution now pass both houses again, in order to get the process going? And again, remember, ultimately, we've got to get the bills to pass the House and the Senate. And that also is a complication. So we'll talk about where we're at. So the good news is it didn't go off the rails this week. I think it's probably what we can say so far. But we still have a lot of steps left to go. So we'll talk about where we are there. But let's start and talk about what FinCEN did this week, right? So FinCEN announced basically that there will be no penalties imposed under the CTA pending the issuance of a revised interim final rule. This is a news release from FinCEN. FinCEN came up and told us that. Now, the key issue here, if you look at the information that we have, is that essentially what they've told us is they will not issue fines, penalties, or take enforcement actions against companies that fail to file or update their beneficial ownership information report by the current deadlines. That'll remain in effect until a forthcoming interim final rule is in place and the new due dates for that rule have passed. So we know now that effectively, while March 21st remains technically the deadline, the reality is nothing's going to happen if you don't meet that deadline. But the flip side of that is we also have no idea what will be the date by which you need to get things filed or you'll be penalized. We're still going to await that guidance as to what's going to be coming. Now, this interim final rule, which will tell us the apparently real deadline, where every time you say that, you really wonder about it under this program, but we'll go with that for now. It will be issued no later than March 21st, 2025, right? And it's going to extend the reporting deadlines to some extent and provide new and clarified guidance. Now, unfortunately, FinCEN didn't tell us much about what in the world they're really going to clarify. They just vague discussions about easing the burden on U.S. small businesses, and and making sure to make it so that the high risk entities end up having to provide information that will assist law enforcement or handle them with the various issues for national security, etc. So again, not quite sure what that means, but it's coming. This rule is to be published by March 21st. So this is really, for now, what we're watching with the little, remember that bill in the House that passed the House? Yeah, that still technically could pass. So pass the Senate. So we could still be looking at that. So keep your eye on any movement there. So far, I have not seen any movement, at least as the last time I checked, which was early on Friday, that it's still sat in the Senate, basically waiting action, which is where it had been ever since the House passed the bill on February 10th. So we've been sitting there for a while. We'll see what happens, if anything, or if the Senate's just going to assume that this is going to take care of it. So they're just going to let it kind of ride at this point and not worry about it. They also will be issuing a proposed revision to the final rule. Remember, we're going to get an interim final rule. We already have a final rule. We're now get an interim final rule that's going to make changes to the final rule in the interim, right? So it's like a temporary reg if you were in the IRS part of Treasury instead of in the other parts of Treasury. But then they are still going to go back and make changes to the final rule, which again, if you're in Treasury, if you're in the IRS part of Treasury, you've always called that a final regulation. So that's going to be coming. They will seek public comment on possible revisions to the reporting requirements. And again, the goal of these changes are, and this is where they use the term, aim to minimize the burden on U.S. small businesses, but also ensure the BOI is highly useful for national security, intelligence, and law enforcement. And when you finally get down to this, in one sense, nothing they've said here really adds a lot to what we found in the filing that went in when they asked the Smith court to stay its injunction against enforcement, where they promised that they would delay by 30 days initially the due date, and they'd make considerations for further delays, etc., and modifications. In reality, this doesn't say a whole lot more than that, except clarifying that they kind of realize it's a little weird to say your deadline is March 21st, but in the interim, we're going to consider extending. It's like, okay. So in the interim, you're considering extending deadline. So March 21st may not be the deadline, but you're not telling us what will be. Well, now they're telling us for sure March 21st won't be the deadline, but they're still not telling us how long we're going to have after that. I'm hopeful we will have, reasonable amount of time after that. So they're not just going to announce. I mean, it would be totally in line with what's been said so far. I should say in line. It would be not in line with the implication, but in line with the literal text. If they said, yep, it's due on March 22nd. It was a delay, right? So far, there's no commitment to any date. So I don't know if it'll be a 1-month delay, a 2-month delay, a 6-month delay, a delay till January 1st to 26th. I have no idea how much of a delay we're talking about here, which is a complication for those of us who may have clients that believe we're going to be assisting them in this filing, because we have no idea when the actual drop dead date's going to be. We're still waiting on that. My own comment is you need to start thinking about that if you haven't already had this discussion with your clients, which I've suggested you have before. Look, we can file now. Okay. Now, you don't have to, because this is still in limbo. We don't know when. But if you file now, we get rid of this. You're done, for now, etc., unless you had a change, and we can ignore this. If you decide you don't want to because you don't want to submit this data to the government, okay, fine. But the problem they've got to realize is, your clients have to realize, is that I may not be, or you may not be able to assist them if this deadline drops at the wrong point. Because it depends upon how many clients you have to assist and how much warning we get about, the deadline date before the date comes. And there are definitely bad dates. March 21st was a pretty bad date as it was. So, that's only sitting there, 6 days after the March 15th deadlines for a lot of these entities to file, or at least get those returns extended. So yeah, we're still looking at a bad date in there. It was still bad. So I guess in one sense, it Well, I won't say it couldn't get worse because April 15 would be bad, really bad, but it probably will get outside of tax season, but still, it's up in the air. We don't know the date. And, that means, that you have to commit to being available, on right now, virtually an instant's notice. So that's why I think you and the client have to talk. And also, I would point out to clients, some of my clients point out, I mean, after a while, you're spending so much time and effort keeping up with whether you do or don't have to file this thing, as opposed to just filing it, that you have to consider that cost too. There is a cost because, as I'll tell clients, if it comes at the wrong point in tax season, there's going to come a point in tax season where I've got to put my head down and just start, handling the 1040s in front of me, right? To get the extensions together, get things computed, get things out. If they were to announce the official date or what's going to happen at the wrong point there, I'm probably not reading the news from FinCEN every hour to make sure I know it happened. I may be stuck with a bunch of other things going on. So the client's going to have to take on some personal responsibility here, which is what I would tell them if they're going to do it. But in any event, we have that now. So we'll talk a little bit about how all that, you'll talk with the clients about how it's going. We'll see what happens in the future. Now, next up is a tax court was asked to reconsider a prior decision in the case of Alan Hamel and the estate of Suzanne Hamel versus Commissioner TC Memo 2025-19. Suzanne Hamel, as I noted, is basically the actress Suzanne Summers, who passed away while all of this was going on, and Alan Hamel is her husband in that case, and they were involved in basically a lawsuit, or I should say not a lawsuit, but they were involved in a tax shelter, which things went bad. So the basic issue here, this is a TEFRA case. So that is important to remember that the technical issue decided here isn't really probably going to be relevant to your client unless you're in an exam right now, or your client is in a TEFRA partnership, that where one of their years is under exam right now, right? And what happened in this case is, and this goes back to essentially how all of this goes, right? Right, they were issued to the Hamels on March in 2021. They were arguing that effectively, they were indirect partners, right? They had been indirect partners in the partnership. Now, the IRS issued regulations under then Section 6223, the TEFRA 6223, which basically said statutes didn't begin to run on assessing tax until effectively indirect partners were fully disclosed. And the Summers, who were not directly partners in the partnership under exam, but got it through an indirect process, they were the ones kind of in line here, saying that in essence, it was, basically, those temporary regs 301-6223C1T, those regs they said were invalid, and they asked the court to reconsider because the court had based its decision that the regs were valid on a prior ruling, Goff Properties, that had held that regulation valid, but that analysis had been conducted before the Supreme Court issued its Loper-Bright Enterprises opinion. As we discussed earlier, Loper-Bright was the case, that said Chevron deference no longer was the standard. And Goff did rely on Chevron deference. So we have a Chevron deference here. They're saying that rather the court needs to go back and reanalyze the reg to see if it was, essentially under the statutory construction theories, was it actually the best possible option for interpreting this reg, rather than just a reasonable interpretation is what they're looking here, right? So bottom line, they said, hey guys, you need to go back and take a look at this, under the Loper-Bright reviews, right? So what they're arguing is they said, look, Loper-Bright and the Goff Properties, that really Goff Properties is a Chevron case, and we're saying that Loper-Bright, we're claiming, would result in a different answer than Goff Properties. applying the Loper-Bright decision in Goff Properties, essentially would invalidate their analysis. So they were looking at the validity of that proposed reg, and they were looking at, those temporary regulations, right? And jurisdiction over penalties. So various things challenged. Now, as the Supreme Court told us in Loper-Bright, it's not true that that if a precedent, a regulation had been held valid under, prior to the issuance of Loper-Bright, where the court did what the Supreme Court told them to do and used Chevron as the test, it's not automatically true that a regulation that passed Chevron deference is not valid under Loper-Bright. As a practical matter, every reg that passes Loper-Bright is going to pass Chevron. So if the reg would be valid under Loper-Bright, it would have been valid under Chevron. The inverse is not true, of course. Every regulation that would pass the Chevron test, which is it a reasonable interpretation of the law, not whether it is the best using standards of statutory interpretation of the law. Yeah, not all of those are going to clear, right? So there would be some. The key question is this one in the analysis in Goff, is this the way it works, right? And what they're saying here, the court went back and said, look, it said, we're going to go ahead, and we found that Section 6229C does not clearly prohibit an agency from promulgating regulations which require information to be filed with relevant statute, filed where the relevant statute provides the information must be furnished. Furnished is in the statute. It's a term used in the statute. And the question is, what does furnished mean? And the IRS had various rules in there about how indirect partners were to be disclosed. And the partnership was to furnish information about that. And they're saying, that it's not clear to us, under statutory interpretation, furnished would invite some ambiguity. And the court said they don't see that what the IRS did in this case is any violation of standard rules of statutory interpretation. So they said, even reanalyzing the Goff Properties decision under Loper-Bright, it still was, what they're going to say, a valid regulation. They didn't see there was a clearly better alternative. Total free-for-all, is kind of how the argument would go. A total free-for-all where it could come any of 45 different ways from every different direction. That really doesn't seem like what the Congress was aiming for. So, so they're going to say it's there, right? So they found that the court was not prohibited from issuing, essentially these regulations, that the law itself was not clear about what these things mean. And therefore, the court found that, in fact, the regulation was valid. And so, bottom line, it grants the IRS's motion to dismiss for lack of jurisdiction. In this case, saying that, it's statutorily fine. The court can't step in and throw it out here. They also grant the IRS's motion for summary judgment for the liability in this case, right? And they deny the motion of the estate and Mr. Hamel asking for, basically them to throw out the IRS assessment entirely, right? So essentially, this is a tax court saying that, yes, we realize that, the case that tested the validity of this reg, which is true of a lot of cases, any case that asked for validity of a regulation following Chevron was going to use the Chevron test. But as noted by the Supreme Court, the mere fact that they tested under Chevron does not mean the answer is going to be different under Loper-Bright. It does mean it might be. It doesn't mean it will. And the court interpreted. Now, whether the estate and Mr. Hamel are going to appeal this decision, that's a different question, because obviously, the next step would be to take it up to the Court of Appeals, ask the Court of Appeals, to apply the test, etc. I'm not sure the Supreme Court would want to get involved in a case like this because, A, it is dealing with TEFRA, which is basically no longer terribly relevant, and B, they're not thrilled with tax cases normally. So unless the Circuit Court's opinion got different opinions in this case, I don't see the Supremes picking this thing up, but you might see the District Court. But it is an interesting case to look at if you want to kind of see how a court's going to deal with, oh, look, the precedent you relied upon, use Chevron because that's what they were supposed to do, right? That's what those cases had to be decided under. You can't ignore a Supreme Court precedent unless you're the Supreme Court. Right? The Supreme Court can override it, and say, hey, the precedent, now we're going to do it this way. But yeah, so we're going to see a lot of Loper Bright challenges. We've already seen a number of them. I expect we'll see more. So yeah, just kind of keep that in mind. Okay, next up, the IRS has released its Dirty Dozen tax schemes for dangerous tax threats. Right, this is something the IRS releases every year. Right, so what the IRS does, it identifies 12 basically threats for a year, tax scam schemes, and talks about what they are so that taxpayers are supposed to be made aware of it. Tax practitioners are made aware of it because one of those aim very much at tax practitioners. And be aware these things are out there. Some of the risks of falling for this can be financial loss. Some of these will take your money for something that doesn't work tax-wise. You have, if nothing else, the risk of a big penalty that you'll get into because you're doing something that isn't allowed under the law, but you fell for the scam. Identity theft, a lot of cases, we're seeing this being used. Various tax-related items are being used to attempt to get personal information from people, by claiming to be the IRS or by doing certain other not necessarily great things in order to get personal information because tax information is highly personal. The campaign's been going on since 2002. And again, the purpose of this is to educate the taxpayers, right? So what are the Dirty Dozen scams? Well, the first one they want to remind people of is email phishing. This is a big identity theft. And both phishing and smishing, just in case you haven't kept up with the terms. You probably know what phishing is now. And yes, it's spelled that way. Those fans of the band, will figure out why it's spelled PH. But that also tells you about the time it got its name, as to when were fans of that band in a position to influence these names in tech world. And yeah, that's where it comes. So what it is, that they're going to be some sort of communication, either email, and the IRS says text, but I want to kind of expand that. It could be an iMessage. It could be an RCS communication. It could be a WhatsApp message. Any sort of messaging app. I've seen a lot more stuff recently that is flaky come through. I have both an iPhone and an Android phone, and I'm seeing a whole lot of iMessage and RCS scams. I think partially because, on the proper platform. So iMessage for iOS, RCS for most Android systems now. The message comes through encrypted, so it's tougher for any scanner at the, at essentially either the, Apple for iMessage or, Google, essentially. Well, not really Google, it's a phone company, but they're going to get a server, most of which they've got from Google to do this. Can't really look inside that message to catch the scam. It does it. And probably the belief is it makes it seem more legit because, oh, this is the secure messaging I'm getting. Yeah, look, secure means nobody else could read it, which is not necessarily a good thing if it's a scam, because nobody who could have scanned it and said, hey, this is a scam and stopped it from getting to you ever saw it. So understand that there are a lot of non-absolutes in this world. And I always cringe a bit when people talk about security. It's like, okay, what security are you getting and what aren't you getting? And for scams, yeah, those encrypted messaging blocks can be more of a problem than an advantage. If you get an unsolicited, right, secure message from somebody you don't know, then question it. If you get an unsolicited, secure message, even if you do business with or you're involved, like what you would be here with the IRS, you still have to really question whether it's legit, because scammers are using it in many ways, right? So, as I said, the idea is to trick victims in providing personal financial information, which can lead to identity theft. These mails can pose as being from the IRS. They can pose as being from the various state revenue departments. Or they could pose as being from tax software companies, and that they often there have been a number of scams over the years that have used, phishing or smishing operations that claim to come from the major tax software providers and threaten that the provider is going to be shut down, won't be able to e-file returns anymore, et cetera, which basically is a shutdown these days, if they don't act right now, right? Panic is always part of what they do here. So be aware of that. They also warn, this is more for the general public, don't trust everything you hear on social media. There's a lot of very bad social media advice, right? Whether we're talking about, X, we're talking about Instagram, we're talking about TikTok, whatever status TikTok's in at this point. We're talking about Facebook, YouTube, YouTube, these types of videos. Basically anybody can post anything, right? Nobody's scanning even what I'm doing right now. If you're watching it on YouTube or, if you're watching it on Vimeo, neither place scanned and said, oh yeah, this all looks legit and fine. Social media, you got to be really careful. There's a lot of inaccurate or misleading tax information on social media platforms. And again, some of it is aimed at getting ID theft. Some of it can get you into big tax problems, right? Don't fall for these scams. Really important to confirm, right? And I do want to say somewhat, even to tax pros, confirm. Make sure, right? I don't care. You hear that something is true. You hear it, even on this broadcast. You want to go back and confirm what was their source for saying this is the case. That's, by the way, 99 times out of 100 when I get asked a question by another pro, I said, well, another CPA told me, that this is true. And I say, okay, what's their source for that? Well, I don't know. They said it. It's like, until you tell me the source, that's, they clearly don't have authority under the law to proclaim, regulate, to proclaim the law or to, set down the law on what it is. They're not a member of the U.S. Supreme Court, and they're not Congress, right? They're not the IRS, Treasury with regs. So they have no authority. So I need something more than that, right, to go with. And you need something more than that. So kind of be aware of that. There are scammers that are contacting people that offer help to create an IRS's individual online account, but instead they steal. This is because a lot of our clients don't find that confusing. They don't know how to do it, but you've told them they should set it up because they really should to keep this from happening. Unfortunately, is the reason why. There are people now setting up and offering to help them set up the account. Look how wonderful it is, etc. And they, by the way, can do this under the nose of a professional. If you're saying, no, I don't deal with that, I don't want to do it, well, if you're being uncooperative, that sets up a lot of your clients for some nice guy, who's approaching them and saying, oh, we'll set this up for you. If your tax pro is too dumb to understand how to set up an online account or can't be bothered to help you set up your online account, we'll take care of it for you. Which usually they end up taking over the account. So it's kind of bad, but that's still something we see. Fake charities. We see a lot of this every time there is some sort of big disaster. They set up fake organizations, just to exploit public generosity, steal money and personal information. If you donate to one of these, you don't get a charitable contribution deduction. You need to tell your clients they need to confirm the charity is legit. Right? They need to make sure it's involved in the list of charities for which you could claim a tax deduction, right? That kind of needs to be there unless they claim to be a church. And if they claim to be a church, like try to figure out if that church really exists. That's a little more work, but not horribly more. You really need to kind of take a look and see if these organizations are legitimate charitable organizations for deductions, because these fake charities do get set up a lot. I would tell clients it's probably better for you to go out and deal with charities that exist and are legit and go through them. You can go through various charities, you know what they are. If you're somebody if your client is involved in a religious organization, most of them usually have, charitable arms in their organization that will provide support and relief in disasters, etc. I mean, just contact there. Don't just take the online or whoever sends you a mailer. That's the way you get in trouble, because that's something that people have. The next one is kind of sad. What we have here. No, I guess no. This one is. Oh, I skipped one. Fuel credits. This has been going on for a long time. Taxpayers are misled to believe they are eligible for the fuel tax credit. That is limited to off-highway business and farming use, right? They will entice everybody to believe they can get a credit for the fuel tax they paid. Yeah, the IRS has, the IRS looks at these every so often, and yeah, it's not there. If you're not using it off-road for those things, don't fall victim for, oh yeah, my buddy said, or I saw on social media. I'd love to put it there. Yeah, I just filed this form and I get this back because I just put how many gallons of, fuel I bought this year. It's like, it's not how it works. Now, the one that's sad is the next one, the fact that we're still doing this. Taxpayers are attempting to claim the credit for sick leave and family leave using Form 7202 based on income earned when they were an employee. There's so much wrong with that sentence, but let's talk about it. First thing is, right, it was only available in 2020 and 2021. You could not get it unless you were self-employed on a 1040, right? It was for people that were employees, their employer got the credit, right, for paying them, for giving them a leave time. So this was to make it even for the self-employed, who obviously, if you're self-employed and you pay yourself leave, that's not really doing anything, right? Because it's like, well, yeah, that you're going to get that money anyway. It's like it's not there. You couldn't work, so you couldn't earn. That's your problem. And your clients are not likely to just voluntarily pay you leave time. But that only applied in 2020 and 2021. So yeah, that's not there. And certainly, and by the way, it's a huge, so, you tell clients if they're calling in and claiming, I was told I get that credit. I saw this on, Instagram. I saw it on X. I saw it on Facebook. No, quit looking for information there, because you clearly don't know how to tell scam from not scam. By the way, I should say about social media, it's not there isn't good information on social media. There aren't good places and people, but you can't just blindly trust people. And the thing I always tell people is, be very leery unless you do the background checks and find out who these people are, because there are things you want to believe. And merely accepting what you hear somebody say in the YouTube video that, let's say, is suggested to watch next, because they say what you want to hear, you need to be even more skeptical if they're saying something that you would want to be the answer, or that you want to hear, or you're inclined to believe. Just, be even more skeptical, because, a lot of people play that, and then they can work with it. They'll do it. Sometimes even these groups will do a scam, knowing that it's very, very easy to, bring certain people in who are on the far fringes politically, who are wildly one side, wildly the other, that they want to believe, they're out there, everything. The other side is totally, totally evil and is totally going to destroy the world and is totally just a bunch of crooks, et cetera, et cetera. They realize that group wants in, they're grasping to get, to fulfill what they believe. And they'll use that to then, and they'll set up one for each. And they'll then use that to get the scam going. So be very, very careful there. That's kind of where we get this, right? Some of them did decide, hey, you know what? There was they marketed a bogus self-employment tax credits and found false claims for refunds, right? So yeah, and these sometimes may have tried the payroll tax credit. So yes, there is no self-employment credit aside from that one for sick, basically for sick leave and family leave. That was for those 2 years for self-employed, but there's no like general purpose one that occurs over the years or cover things other than COVID. There's not there, but people are pushing it. We also have improper household employee taxes. Some taxpayers invent, as they're told to do on social media, fictional household employees who file Schedule H claim a refund based on false sick and family medical leave wages. We're getting close right now. We're almost to the point where a claim for refund for 21 can't be filed anymore. But yeah, there are some people that have had that done. Other thing, we kind of talked about this, I think it was just a week ago or 2 weeks ago, about the overstated withholding scam. In essence, make up large income and withholding amounts on W-2s to get a substantial refund. And I mean, the IRS says if they can't verify the information, the refund will be held. More likely, how it's going to play out is if you file early in tax season, there's a good chance you'll get the refund. Because remember, how long does it take you to see the W-2 data show up in the transcripts? Right? It takes quite a while for the computer to really get that information internalized. Right? It's going to take a while to get that posted. And right, in the interim, the IRS will issue the refund because Congress people get, constituents yelling at them that the IRS is holding up refunds too long. So that's how the money gets out. What happens, of course, in a few months is they will get a notice and the IRS come back collecting that money. And as we discovered, if they tell you, oh, the IRS can't do that, they won't be able to get the money back because it's not really an understatement of your taxes. So, the law doesn't allow them to fix that. It's like, remember, we had the case a couple weeks ago. Yeah, that's considered an understatement of taxes. They can collect it. If they're telling you the law doesn't allow for that, we've already had an update here recently where the court said, yeah, the law allows them to go get that. Sorry, quit playing this game, is basically what the court said. We also have some not so upstanding OIC mills, offers and compromise mills. Unfortunately, it's a thing that comes up because quite often those of you that do work in collections, you have to give clients bad news or give them a lot of options, none of which are great. Some are less not great than others, but sometimes the answer is simply, we just got to wait out the 10-year collection statute and hope the IRS doesn't go, and convert it to a judgment, and find property to attach. So, sometimes the answer is bad. So these mills will prey on people like that. And also most people who do collections, let's be honest, you need to get, you need to get money up front, right? In essence, you're not doing this as a charitable organization. You need to get paid. And so that also gets them in with scammers, and OIC mills will come in cheap. So they'll basically, they will, or even not so cheap. If you told them they can't qualify and this online thing says, oh yeah, you can, they'll get them, they'll start the process. They'll do misleading things, but they'll get it going and get the money up front, disappear later, for people that really don't have it. Right? They also worry about the ghost tax return preparers. You've all seen these. I think some of us have run to returns that appear to be done by that. We take over a client. Preparers charge a fees based on the size of the refund, and they refuse to sign the return or include an IRS PTIN. That's a ghost preparer. The return appears to be self-prepared, and that's, they make use of that, right? That is a huge red flag if you have somebody, anybody who's using a ghost preparer, if you have a friend, relative, whatever, that you discover, oh yeah, this guy does it. And unlike you, he's going to just only charge me based on a percent of the refund. It's like, and he's not signing the return. Yeah, that's like you're being set up to be the fall guy for an overclaimed refund that when the IRS discovers it, the ghost preparer will be long gone and you'll be the one having to pay. And according to that return, you're the one that determined that was true, right? It wasn't some other preparer. You're now claiming this other preparer that we can't find anymore. Somehow this preparer did it, but the paid preparer wasn't signed. Did you notice that? Other problem. And then for pros, a big issue. We do have the new client scam. You're probably used to that. They impersonate new client to get you to respond to an email and eventually get you to basically you'll get either a malicious, I'll get that out right, attachment, or be directed to a website, a URL that is meant to, in theory, get their data, but in fact will just compromise your system and allow them to go in and use your system. This is used a lot to try to hijack professional systems to file false, tax return claims, false, basically e-file, e-file basically fraudulent returns using that, right? They can steal the client data as well. Lots of times they'll do that too. Might as well pick up that too. You can sell that stuff on the dark web, so they'll pick that up as well, and they'll take your identity. So the fraudulent returns and spear phishing is one, where it's directed. This is not necessarily generic phishing. Sometimes generic phishing is the client scams, but normally these are more aimed. They've gotten a list somewhere where they know you are a CPA who's in tax. They know you are an EA that's in tax. They know what you're doing, right? They may have even discovered that you do it because they've been able to, basically one of your clients managed to screw up and let these guys into their system through whatever attack they had. And they discover that you're the tax preparer. And so they can appear to be all kinds of neat things from that. So be very leery about those, email scams or any email that says, here's something, please attach it. It's really getting to the point where you really under the SSTS you should be discouraging clients heavily from emailing you like PDFs with their personal data. Basically, nope, we should go through a secured method. So we should be discouraging that heavily anyway. But the existence of this sort of thing and the fact that sometimes they compromise clients' machines and send these things. And yes, I have seen that in a case a couple of years ago where a client's machine got compromised. And suddenly there was sitting in my inbox, the inbox of one other person in my firm, an email from the client. It was literally from his machine that had this attachment that really didn't seem to make sense as to why would he have sent us this thing. No, he didn't. That attachment, had we opened it, would have essentially had malicious code that would have exploited a problem in Excel that would have allowed, them to take over the machine and then blast out to all of our clients. And you can imagine how bad that would have been. One of the ways we caught it was, turned out his investment advisor didn't figure out it was a scam. Didn't figure out it's a problem email because suddenly I had a virtually identical email from his investment advisor sending me something that was like, well, that doesn't make sense. I'm not your customer. And why are you sending me a spreadsheet, which the client indicated was the spreadsheet that they had done? Why are you now, none of that makes sense, that attachment. So yeah, I just said, I sent emails to both saying, guys, check carefully. I'm thinking you've been compromised. Because we're looking at a problem here, yes. And so everybody got emails out. It had been compromised. We're very aware of the problem. That happens. Be aware of that. I mean, it's something that has. Finally, the IRS asked for individuals, if you find a proper tax scheme, there is an IRS form 14242 on which you can report those scams. Okay. Next up, another IRS report this week they posted. The IRS, in this case, added, and this is found in News Release IR 2025-28, issued on February 27th. The IRS indicated they are now adding W-2s and Forms 1095A to the 2023 and 2024 tax years on the IRS online account. Clear how quickly they'll get up there. Not clear what'll happen, but they'll be there. Now, this is useful because a lot of times you may have clients that don't have their W-2 for whatever reason. They've lost it. They still should try to get it back from the employer regardless, because as the IRS will point out, this W-2 here will not have their state information. Or the 1095A is one that often trips them up, and then they can't remember how to log into healthcare.gov. They can't figure out how to get their 1095A, and we've been down that one a few times. We've been there. Luckily, I don't have a huge number of clients claiming the premium tax credit, so I don't have this very often. But every so often, you run into one who's on there for whatever reason, and you need to get their 1095A, and so you're trying to get it. So again, it'll be on there, right? And again, it puts that tax records will be in one location. Obviously, the IRS's goal will be eventually to have everything come up there. We're going to assume that would be in, the income report, the wage and income report. I presume they'll look to getting it up there, so that'll be issues. Now, they can get those items, plus currently they can get on the site. In addition to accessing that data, they can view key details in the most recent tax return. They can request and view their identity protection PIN. They can check their refund status. In that case, they can get full-blown account transcripts, wage and income records, including records beyond just the 1095A and the W-2. They can electronically sign certain tax forms with the IRS, including, the power of attorney to authorize you to represent them or get access to things. They have various things. They can view and edit their language preferences and alternative media. They want to look at, they can receive and view over 200 IRS notices. Unfortunately, not really all the big ones yet, but we'll get there. They can also view, make, and cancel payments in that account. And they can set up or change payment plans and check their balances with the IRS. So there's lots of neat things about having the IRS online account. I know I've got mine set up. I think everybody should set it up. It certainly is much more convenient to figure out where you stand if you have the online account set up. And as I always tell them, the real concern with me with the service is, what does the computer think you owe? I don't care what they're telling you on the phone line. If the computer thinks you owe money and nothing shows as being held, or nothing shows that that's clearing up, we still got a problem, because the computer is going to go send it off to somebody else. Is the other problem eventually there. Now, as I said, only the return documents issued in the taxpayer's name. If you're a married couple, both need to get their own online account with the IRS, because while I can look at my W-2 online, I can't look at my spouse's W-2, and vice versa. So they need to have their own account, only their stuff with their ID number as the lead. Whoever is the ID number on the form, on the information form, is who you're going to get access to this. Only the number of things that relate to that person. Missing or incorrect documents, really, you should still contact the employer or the issuing agency. And the most important problem we get here, we have to try to rely on this stuff, is you don't have any state or local tax data. So while you might be able to figure out what the feds have for withholding, you can't figure out what the state, what basically, let's say, what the state withholding's been, or what the city withholding's been, if you have that problem. So those are all part of it. So they're improving the online account. They're adding a couple of things to it. I would certainly say, as a professional, get your own account ready so you can at least go in there, look at it, and understand if it might solve a client's problem if they set it up. And yes, you might want to consider, offering to help certain clients set it up. At least, if nothing else, so they can sign a power of attorney electronically and you can get a look at stuff, right? Because that can solve things way faster than most of any other method of getting involved with the service, is if you can get the online transcript and you have the power of attorney allowing you to go back in there and keep looking at it, right? To see, okay, what does it say today? That's kind of the background. Okay, we're going to close out this week, I should say, with a couple of legislative discussions. Okay, first, we did have the House Ways and Means Committee pass out of committee 2 disaster relief bills, H.R. 1491 and H.R. 517. These passed by overwhelming bipartisan votes, and they deal with different topics. Basically, that's kind of what we're looking at, and kind of how we're doing it. So we're going to kind of be looking down that path. I see my phone decided to start talking. Kind of interesting. They think you're talking to them. Always bad, and it was too close, so of course it hurt. So let's talk about the tax filing relief for disaster victims. This is under H.R. 1491. Now, it will treat automatically a period filing extensions due to a federally declared disaster as an extension of time for filing a claim for refund or credit. Remember, we had that in COVID. The IRS granted special relief. But remember, the time for filing a return didn't necessarily extend the time for filing a claim for refund or credit. The IRS had to specifically provide for that. The law will now update that any claims for refund or credit falling within the disaster, within the time frame the disaster period will set up, for relief, that'll automatically push those dates as well. Make it very clear so the IRS doesn't have to do it. And it ties the deadline for mailing a notice and demand for payment to the postponed filing deadline. So essentially, the postponed filing deadline will get moved, right, for everything. So we're just going to make it consistent, because currently the law provided for only certain things, moved it, not all. H.R. 1491 will look about doing that. So, right, The amendment regarding the extension of time for filing a return under H.R. 1491 would apply to claims filed after the enactment date of the Act. Please remember, this Act has not been enacted. We are just out of one committee. Now, it's coming out of there with a really, really, really good vote, as noted on the screen. If you're looking at the video version of this, there is a 44-0 vote that passed out of committee. So there was not a single no vote, right? It wasn't like all the minority party members abstained. That's, we had votes from both parties, no problem here. The amendment regarding collection notices applies notices issued after the enactment date of the Act. Enactment date of the Act will be the date that it is passed both chambers, right? If we need a conference, it went in conference and both chambers then passed, the conference bill and is signed by the president, or becomes law via the other much less likely mechanisms that it could become law without necessarily the president signing it. Right? That's the enactment date. So that's when it will count. So we'll be looking for things like that. Again, H.R. 1491 is not enacted, right? It's got a number of steps to go through, but it is a bill that, because it passed with huge bipartisan support in the committee, it is a bipartisan bill coming out of the committee. It has a decent chance of at some point during the year becoming law. It's a reasonable chance, right? Again, it might not, but so don't work on this assumption, but it doesn't seem like anybody's really against it, so we'll see how it goes. The other bill, H.R. 517, will modify the rules for postponing certain deadlines by reason of disaster. First, it will allow Treasury to postpone a deadline after a state-declared disaster, even if the feds have not declared it. Currently we need a federally declared disaster before the IRS can postpone deadlines, before those deadline postponements come into play. And sometimes it takes quite a while for that to get issued. So this would eliminate that. The IRS could simply just do it. It would also increase the mandatory deadline suspension, which was recently up to 60 days. Now, if there's a federally declared disaster, we'll go from 60 days to 120 days. That'd be 6 months, which is more in line with what the IRS usually offers. Right? So we should say from 60 days, I should say 120. So we'd go from 2 months to 4 months. Again, not quite as long as we usually get offered, 180, but it's definitely long enough to give time and everybody's not panicking. They got to get everything done by the 60th day, because that's all until the IRS provides additional relief. And this amendment would apply to declarations made after the date of enactment of the Act. So again, when it would be, it's still got to pass the House. It then has to go through the Senate, pass the Senate. If the Senate makes any changes with the House passed bill, it has to go to conference. If it goes to conference, then if the Senate passes it without changes, it goes straight to the president. If the Senate passes it with changes, it would go to conference. And once it goes to conference, they produce a conference bill, hopefully, after which that has to go back and pass each chamber. You're not allowed to amend that when it's a conference bill. The point of this is to get one bill. You're not allowed to make more changes. It's kind of the background. Now, again, this passed with a 42-0 vote. I don't know why there's 2 votes different. But basically, obviously, those 2 didn't feel like voting no. I have a feeling those 2, just for whatever reason, because you ever watch a committee meeting, people do go in and out of the meetings because they get called to other votes. There may be a floor vote. There may be other things happening. They may have to go handle something else. So, yeah, maybe get called in by the majority leader or the speaker, to discuss some issues. So, right. Various reasons why it won't be there, especially on a bill like this, which has no real opposition. It's not as if we need your vote there to pass it. So, yeah, I don't think you can read anything into the fact there are 2 fewer votes for this one, right? If they really were opposed, you'd see a 42-2, right? So if they're just not voting, that very likely means they, it might mean they have some reservation and they're abstaining. But it probably just means they weren't available for that vote. Okay. Now let's go to, that one was mainly bipartisan, and yes, the minority party, as always, got their standard yelling at the beginning of the session done about things. But, when we got down to the business, everybody passed everything, nothing big happened. Now let's go to the one that is very partisan, right? These are the budget resolutions. And we've discussed this a little bit. Remember, we talked about reconciliation in the past. That is a process by which if you have the White House and you have majority control of the Senate, majority control of the House, you can pass certain tax and spending related bills in the annual reconciliation process without having to get 60 votes in favor of being allowed to vote in the Senate, which is usually what kills bills in the Senate. Right now, and ever since 2010, I believe it was, ever since 2010, right? 2010, when we had a Massachusetts special election that filled the empty seat for Senator Ted Kennedy, no party has ever been in a position to pass a bill with only their votes without having to use reconciliation, right? So it goes back now over 15 years. The last time a party, if they could hold their members in line, could pass a bill without any members of the other party, without going down the reconciliation route. We're not going to review reconciliation in detail here, but just recall it's got to be related to the budget. It has to make changes in taxes or spending. Those are there. There are various rules that for 10 years, it can't, it can increase deficits over 10 years, projected deficits, but can't increase them beyond 10 years. We have other various rules, but it does mean every Democrat can vote no in the Senate and they can't block it. If we're looking at a bill that can't go through reconciliation because it doesn't meet the qualifications, basically in the Senate, the Democrats can block the bill. If they hold together, they'll keep the bill from ever getting voted on, right? And, in the last, the prior Congress, the Republicans blocked many bills that same way. This is not only one party does it. Let's be very honest. Everybody does it. That's how you play the game now. So yes, we saw a lot of that. So this is the mechanism by which we would expect if the TCJ is extended in any way, shape, or form, it will be via a buzzer continuing resolution and using the budget resolution. So let's talk about this. I used three sources for looking at this because obviously the big question is not so much the text of the bill they passed, but what exactly looks like the objections to each house about what the other house is doing, and what are the potential problems of getting people to vote for the bills, and does that suggest there could be a problem later down the line that could derail the process? Okay. So I looked at one article that was in Tax Notes Today Federal on February 26th by Doug Sword and Katie Labosco, which was House Advances Budget Plans Setting Up Cross-Chamber Conference. Also, two articles by Maureen Leddy from RIA Checkpoint News. First one on February 24th, Senate House moving forward with separate tax reform approaches. And on the 26th, the House moves on one big bill approach to tax reform. So those are the main sources I was using when I'm compiling this. Plus, I'm basically aware, and what was in the bills, in the resolutions, which probably we don't care quite as much about right now, because the problem is we got to get to one resolution. And right now we have two. Now, what happened right now is the House passed its resolution, House Concurrent Resolution 14, right, with a narrow vote of 217 to 215. It passed by the skin of its teeth. They basically, because of absences on Democratic side, they had a little extra wiggle room, very little. If every Democrat had shown up, every Republican shows up currently. Remember, there are 3 unfilled seats for which, that were Republican, but aren't filled now because of, Matt Gaetz not taking his seat in Florida, and 2 other members, having to resign their seats because they were appointed to serve in the administration. So we have 3 empty seats. So technically, if everybody showed up, the Republicans cannot lose a single vote, or this would have failed. As it was with some Democratic absences being unavailable there for various reasons, they had 1 vote to give, and they gave it. Massey voted against the resolution. All other Republicans voted for, so it passed by 217-215. Now, realize, a major way it got passed was both by the president doing doing lobbying on certain members, but also by both the president and the speaker noting that this is only this is merely basically a technicality to get the process going. This isn't this doesn't really doesn't cut any programs as of right now, doesn't change anything. So, basically we'll come back and look at the bills, and that's where all this would happen. So unfortunately, it does get the win through, which they needed, because if it failed at this point, it just fails, right? And now, everything falls apart now. So they got it past that point, but it's kind of like your team, your football team. There's 30 seconds left on the clock. They have a 4th and 2, or a 4th and 2. So they get the first down, but they're still on their own 15-yard line with 30 seconds left to go. So while they kept the game from ending by getting the 4th down, they haven't really assured they're going to win the game by any stretch of the imagination. They still got a big job to do that. And while not quite as dire as being 30 seconds to go on your own 15-yard line with no timeouts, and being down by 6, being down by 7, so you're going to have to go for 2 to win. It's not quite that dire, but it's not the greatest. They did what they had to do. They got it through this far. In the Senate, they had a bit more room. So there they also lost a vote, but it was 52-48 there. They passed a resolution. Now the problem is the resolutions are not the same. They're radically different. The House is pursuing what's known as, you remember the one article referred to it this way, it's been called the one big bill approach or one big beautiful bill approach, because that's how the president referred to it. And a quote early on, their idea is they want to take everything they want to do. Money for the border enforcement, money for defense, and all of the tax provisions of the TCJA, right? And do all that in one giant bill. The Senate is going with a 2-bill approach, right? And what they're doing, this is their favor, and what they passed is a budget resolution that doesn't touch the TCJA stuff. So that means if we go the Senate approach, in essence, to quote the old line from Star Wars, this is not the bill you're looking for, if that's what happens. These bills will not be it, because they will have pushed it to the process for what will be the second resolution they could take up this year, for the year that begins October 1st, where they would do the tax bill. So right now we have one big bill that does both, or what the Senate's looking for is the one big bill approach. So they're going to look at a process that handles all of that at once. The House is looking at just doing the easy parts, right? Which would be just the border security issues and dealing with border security funding and dealing with, defense spending on certain projects, and take the easy wins. Now, unstated, or sometimes flat out stated more than once by members of the Senate, is they don't believe the House can make the one big bill approach work. And the 217-15 vote on the resolution is not going to exactly reduce their anxiety in the area. Now, the House believes that is the only way they can get it done. That if they don't do the one big bill, the TCJA stuff will never get passed, because they have some very, very strong fiscal conservatives who want to see the budget, who want to see basically the deficit reduced dramatically. And the only way they think they can pull all the votes together to make them happy and others who will vote against many of those cuts is if they would have to vote against the popular things at the same time. So both of these are based on the fact that we expect the House to be a very difficult way to get this through. So we'll see what happens. Okay. So some key potential conflicts that we have here. Spending cuts are big. House resolution requires several committees to find spending cuts. Again, now the articles said no, the Democrats were concerned about cuts to Medicaid and other benefits programs. Again, they're kind of irrelevant, but who's not is there are Republicans that are also very concerned. In fact, Medicaid has become a big deal. And because both it is the program that the fiscal hawks believe they have the biggest chance to get some real savings out of and some real reductions in. But many Republicans, certain Republicans in districts that aren't very well off, they have a lot of older residents. They have a lot of, their residents are depending on Medicaid and they don't want to see it cut. We know we already had a letter signed by 7 Republican House members who are in predominantly Hispanic areas that basically, they didn't say they wouldn't vote for a bill if it cut Medicaid, but they're strongly suggesting that's likely. So it's a flashpoint. We have other things. They also want to do some cutting in defense, etc. The House resolution specifically provides that you're going to get your full extension for the 10-year period for TCJ, but only if they find $2 trillion of spending cuts that they can enact at the same time. They have to find 1.5 trillion. But if they can't get the other the other 500 billion, then they have to reduce what they're going to extend on TCJ or just leave certain extensions out entirely. So yeah, that's involved. Senate is very concerned about the price tag of the Senate resolution, and Rand Paul voted against it, right? And many of the House members are. Many of the House members believe, especially the deficit hawks, that that the Senate's not serious about reducing future deficits. They're not thrilled with the Senate talking about scoring it based on current policy versus current law. Current policy would say, hey, these things with TCJ are already in the law, so we don't need to worry about, extending them doesn't cost anything. Now, as was pointed out in an article, that's a little weird because then they're going to have to make some change to it because it doesn't cost anything, it doesn't do anything, then it can't be part of this bill, which is kind of the whole point. But they want to use that current law baseline to not have to count anything that extends the TCJ. The House people that want to see the deficits come down and see actual reductions in the, in the national debt are saying, guys, we don't care about your scoring game over here. What we care about is the real deficit. And that has to come down. And, if you guys are going to continue out the revenue side the way you're going, you better come up with offsetting spending cuts to make that work, to get these things to go down. You can't just pretend you're out of it. So there has not really been much appetite yet in the House for the current policy theory, because the fiscal hawks aren't going to, they don't care which way you score it. That's not their concern. Their concern is whether you actually cut the deficits every year and whether you actually, make a reduction in how fast we're running up the national debt. So yeah, we have a problem there. Rand Paul is the one in the Senate that seems to be heavily that way, but there are definitely more than a few. In fact, in the House, they had to make a lot of compromises with that group just in order to get this through. So that's a real concern, right? Again, and this is important because, as noted on the third bullet point, in order for the process to move forward, the House and the Senate have to pass identical resolutions. We are now going to a conference committee. And there have already been threats made that if you touch what we did, right, if it comes back radically different from what we passed, I'm not voting for it. And since these two are very different with each other, one chamber or the other at least is getting something back that's radically different. So we have to kind of watch that. Again, the narrow margins mean there are very, 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 very few, votes that can be given. I mean, and they gave one vote in the House in the vote this time, and that's all they had to give. So, we can't really, you're going to have to hold all the votes. And as noted already, you mentioned about fiscal responsibility here. House Republicans, the Senate's less fiscally responsible. That's why the Senate, which is why the House thinks we've got to drive the narrative, because we're the ones that are trying to actually get the annual deficits down, right? In essence, we're listening to the Senate talk about playing games to not count. what would essentially be about 4.9 trillion. We're not going to count that. And while it might okay for the bird rule, I think as Representative Roy said, well, I don't really care how you score things. What I do care is we got to reduce the deficits going forward. And and the perception is the Senate's using that current policy as a way to ignore the actual deficits that would be coming up down the line. So now they want them to go back and say, we don't care. We're looking at actual deficits. And we're not voting for it to increase actual deficits, regardless of whether or not, the Democrats could object to the bill. We object to the bill. It's kind of what Representative Roy was saying. I object to the bill. So that's a problem. Remember, and Roy voted for this, but he voted, as he said very clearly, to move it forward. Just move the process forward. He's not yet committed to actually voting for things. Finally, the budget regulation process sets up, in essence, the budget resolution is the first step you must take to go down reconciliation. Reconciliation is the only way the Republicans can pass their bill without Democrat votes. And if you have to get Democrat votes, it would be a radically, radically different bill. They'd have to give up some big things to get there. And that would be politically a disaster. I think that's the only way I can say it. I think politically it looks very bad. That, especially after 8 years ago, when a similar problem with what they thought was a narrow majority then, and it looks like a huge one compared to now, they ended up having the same sort of, intra-party fighting and the same difficulties taking things over the line, not getting their first resolution over the line. That was the one that was going to repeal and replace the ACA, Affordable Care Act. And the second one then barely got over the line at the last second at the end of December, right? Again, this is going to be a very difficult process, right? Generally, now I say that'll probably pass all in a week, but assuming they don't. Keep your eye on this. Right now, the key question coming out of this is, the conference committee is where they got to make the final call. Is it one big bill? Is it, let's go for the wins and then come back later and go for the tough one? Not sure which way it's going to go. And regardless of which way they choose in conference, can they get both chambers to agree to that? There is still a chance. I mean, right now, the number one goal, I think, of the leadership in Congress is to just keep this moving, right? In essence, don't have a huge, and it's tough to understate how big the loss would be if you can't make these votes go. Don't have a huge negative, these guys are the Keystone Cops, they can't do anything, right? Get it together. So we'll keep our eyes on it. We'll keep our eyes on when the process goes forward. I'm suspecting that if everything worked perfectly for the Republicans, so we get, and for us on tax, we'd like to know the answer as soon as possible. The one big bill is what they do. And if they can actually get an answer that can pass both houses and bills can pass both houses, it would probably be sometime late this summer, August, most likely, would be the earliest I would expect a bill to come through. That's just a rough guess. Sometimes they surprise you. But I would say that if they don't go with the one big bill, then we're going to probably be very late in the year when we get the bill. And don't totally discount no bill, right? I mean, this is the advantage the leadership has is that is so bad looking that it's probably going to negatively impact a lot of Republicans running for re-election if they can't get anything done. And that impact could mean they lose their seat. But again, there are others who feel they're very safe who don't really have much incentive, except being told that, well, that's fine. You can be obstinate like this. And yeah, sure, you won't ever vote for something you didn't like, but you also won't ever get anything you do. So, leadership's got a tough game to play right now. And do not expect the Democrats to make it any simpler for them, right? That's not really their game right now. They're not looking to make it easier. That's how it goes. So this has been the Current Federal Tax Developments for February 24th, 2025. Current Federal Tax Developments, as always, is brought to you by your state-sized CPAs. You can email me, Ed Zollers at currentfederaltaxdevelopments.com if you have any quick questions on this. I'll answer your questions there, whatever else you might have. And that I also do look in on the websites for the Arizona Society, the New Jersey Society, Minnesota, Idaho, Illinois. Look there on their Connect sites. So if you have any issues, you can bring them up there, and I kind of glance in there every so often to see what's going on. It is tax season, so how much I can answer becomes more significantly less as things get wilder and wilder, and we're in tax season. So we'll see how that goes. But otherwise, hopefully you've had a good week so far. We are heading now into March, so we're going to hit our first deadline here. So we'll see that. So this is for March 3rd, 2025. The slide says February 24th. It is March 3rd. We will see you next week for whatever happens with new developments in current federal tax developments.